Do I look more like a trader now? Should I do this with these these glasses? No, no. Anyways, enough messing around. Let's start the video. Welcome back to the channel. Let's talk about the other side of the trading business, and that's dealing with day trading losses. Very serious subject. This video is going to have two sections. First one talking about general reason why people get themselves into losses in the first place, and the second part of the video will provide you with real actionable steps to get yourself out of the drawdown. Whenever people talk about day trading losses, especially relatively inexperienced traders, now in that category I also count traders who have never been profitable for even like 2 to 3 months, meaning they don't really have a clue about what they're doing, but they will blame their losses on others. One of the main ones, broker is stop hunting me. Now guys, this used to be a problem back in the early 2000s when the entire forex and CFD industry was like the Wild West. Brokers didn't even push the client's trades onto the exchange. Instead, they would just net off their own in-house clientele against each other and then just have a market neutral position. And in some cases, they didn't even have that. They just held the trades in-house. Then they would just take your commissions and the spread on top of the real-time price. Very, very unfair. This was known as the A and B book broker model, meaning everyone who loses money goes into B book, and everyone who makes money would go into A book. However, these days, you will find that most brokers are so-called no dealing desk brokers, which means that all client trades are sent out onto the real exchange. Now, this was a relatively recent development, right? 2015. Ever since the fiasco of Swiss National Bank removing the pegged floor in January 2015, unannounced. And this event caused all dodgy brokers to go out of business. They didn't manage their risk properly. They got complacent. As a result, a lot of customers got hit with real negative balances that went into hundreds of thousands of dollars, even if you only had a 20K account. Why? Because the real leverage went straight out onto the exchange. So anyone trading 7 lots would have a 700,000 negative balance, because one lot is 100,000 underlying units. This event also caused new regulations to be created, such as MiFID and MiFID II. Also Dodd-Frank legislation in the USA, the reason why you guys over there cannot trade CFDs anymore. So these days, there is no such thing as broker stop hunt in the Western regulated countries. Now, some might disagree with me on this, but I've seen the way these platforms look like for white label brokerages from the other side, and I know I'm right. So fight me in the comments. But there is such a thing as a market maker stop hunt. It might look like they're hunting your stop, but in reality, your stop placement was not at a strong price to begin with. So just quickly, let's say you're buying crude oil and you place your stop loss just above the round number. Let's say you place it at 40.15. And you know what happens to stop losses for longs that are placed just above the round number? In about 90% of the cases, your stop loss will be popped. Why? Because the institutions that run algorithms, they work off round numbers. They're not going to go into some weird price. So if an algorithm with a buying power of several billion wants an entry at a round number, what needs to happen? The price needs to reach the round number. With that kind of buying power, you can use a portion of it to move the price temporarily, which means they will move the price ever so slightly towards the round number before they start entering the real enormous positions. And when that happens, you're out and they're in. But if you place your stop losses away from round numbers, so for long numbers, place them at 0.80, at 0.70. And hey presto, you have a much stronger position in place. Next thing to do when you're suffering losses is to review your own trades objectively. And it's never a comfortable process because you have to face some of your own inadequacies and to admit that your skills are not there yet. But you cannot just keep trading and trading and trading and complaining and thinking it will somehow get better. I mean, I see this constantly. People kind of fly through the lectures and then they say to me, I understand the profile in order flow now. When are you giving me 50K to trade? Even worse are those who say, oh, I don't plan to trade at all. What, not even on a demo?
Like, what is the point?
I mean, do you not want to test to see how these things play out in real time? How are you going to use them? Understanding order flow and applying it in real-time conditions is not the same thing. Just like it's not the same thing, oh yes, I understand how a human body works because I digested Grey's Anatomy in about 3 months. But tell me this, would any hospital accept you as a resident surgeon with zero practice in surgery? Just because you claim to understand currently abstract concepts of how things work in a human body. So any hospital will laugh at you, because understanding how a human body works and actually performing surgery where a million things can go wrong and you have to think on your feet, using all of your previous experience and mastery and specialty and skills and everything, so that when things don't go according to plan, you still need to make it work somehow, and you still need to make it into a successful outcome. So trading is the same way. You need a lot of skill and experience to make the right call within the context of chart location and order flow sentiment that day. And then when things don't go according to plan, you need to have the same skill and experience to think quickly and strategize in a new way to decide the new course of action. And then you hope that that is going to prevail on most occasions. Why? Because of your previous experience and relying not on just any single trade outcome, but instead on probabilities of your approach that you've presumably tested in a simulated environment. Then remained profitable for 3 months, then went live on a small account to see whether you can translate that into similar results. Understanding order flow and learning to use it correctly in practice under huge pressures, 2 different skills completely. If you are finding the video useful, don't forget to subscribe so we can share the love, share the video with everyone who has complained to you about having day trading losses and struggling with day trading. You may even want to smash the notification bell like it's a hot piece of calling your name. And while we're at it, leave a comment down below too, preferably not one about my mother or my looks. Like, share, comment, and why? Because greater engagement gets this video in front of a whole bunch of other people because YouTube starts recommending it. And at these difficult post-COVID times, when many people have taken up day trading at the prospect of having a side hustle, and they're losing money due to a misinformation and a misguided approach, I thank you in advance. Now, once you have some skills and you're still being emotionally wounded by the losses, this isn't really a technical inadequacy issue, but definitely more a psychological one. So you need to have a mindset shift. This is the second part of this video, actionable steps to take when you're in a drawdown, when you're dealing with losses. With the mindset shift that I want you to start making, you need to stop looking at day trading losses as, boo, I lost the trade, boo. You want an income from this? Start treating it as a business. In every business, you have cost of sales. You have expenses that allow you to generate a profit eventually, right? Well, my lovely viewers, your day trading losses are cost of sales in the day trading business. Sometimes you have to pay some money to find out new information. You have to risk money to make money. As long as your losses, aka your expenses, are planned and controlled, and then you don't go crazy when you lose, just going smashing everything, and then revenge trading to get your money back, then if you're using correct positioning, the correct size for your account, and they are planned losses, you won't be bothered by them. If losses are bothering you still, it always comes back to one of these. Your position sizes are either way too large for the size of your account, or you don't have a daily loss limit, so you never know when to stop. Or, another common problem, you might be chasing an arbitrary profit goal, trading your P&L. Like, I want $1,000 on the day, and you're sitting at like 940. And then you do another trade, oh, just for another 60 bucks, just another 60 bucks. And then you lose that one, so now you're not looking at 940, but instead you're looking at 720. And then you don't reach the 1 grand that you were looking at. That becomes a trigger to all sorts of psychological issues and overtrading. That's why I don't want anyone setting profit goals. They work against you. And at that point, you're not trading your setups, you're just trading your P&L. So what I advise is to start working on your mindset shift. Establish a daily and a weekly loss limit in percentages. And then think of those loss limits as your budgets. It's no different than the budget allowance for groceries, entertainment, new clothing. So set yourself your trading allowance too. How much are you allowed to spend on your day trading this week? Or today. And if at any time you go over that assigned loss limit amount, you need to stop. You've gone over the budget. So don't glorify it, don't over dramatize it, don't assign theatrical emotional display to what effectively are business expenses. And some people have argued with me over using daily loss limits, and they're like, if I lose 2 trades and I can't enter a 3rd one, then I will miss an opportunity that comes next. But if you are in a drawdown for a number of days or even a number of weeks and you're still suffering losses, this is usually an indication that something is not being done correctly. A part of the cog in the machine is not working right. It's either that your reading of the market is off that day or that week, which means you need to stop and identify where the problem is. Sometimes it's the markets. Everything dries up, you can't get a trade. But most of the time it is the trader's fault. So you cannot just keep trading and that magically hope it's all going to sort itself out. In trading, that is the equivalent of sweeping dirt underneath the carpet. So once you start sorting out your mindset and looking at losses as business expenses, you will have a much better time accepting that it's just a part of business. Next problem with a drawdown is that a lot of people have problems understanding how position sizing can greatly affect the results. If you're constantly varying percentage per trade, using 5% one time and then 1% another time, you will need a massive 6R trade to even cover the first loss. Like, talk about making things very difficult for yourself. You must sort out your positioning. Either use the same amount of ticks for a stop loss or use the same amount of percentage per trade. Now, if you've already gotten yourself in a drawdown,
which is probably why you're watching this video,
some people will say, well, you need to stop trading immediately. I disagree with that to a point. I do think you should have a timeout period, but not dealing with with a problem is equally bad. So the first step is to get away from the charts and all markets for at least a long weekend, but if you can, stay away for a good 7 days, just to refresh your mind, refresh your eyes. When you come back to the markets, the second step is to review your previous trades within the framework of whatever method you're using. So basically backtesting your own trades and seeing if you can identify bad trading patterns. It can be either patterns in getting setups wrong, or maybe it could be a problem of grasshoppering out of a trade and trades constantly going into R multiples exactly as you wanted them to, but you're not in on them. These sort of patterns, they become very obvious when you have any sort of a systematic setup. I mean, order flow setups make that part so much easier because there are a limited number of order flow events that can happen which have a particular implication. So make sure you note down successful setups and then see if you can use some repeatable conditions going forward. Then adjust any of your mistakes in sizing. This could be a pattern too, constantly getting size wrong. Next, exclude all products but the one that had the best performance. After that, you want to work out which times of day were the strongest points and which times of day were the worst for you. Then do everything in your power to keep yourself away from the screens during the times of day when you've performed the worst statistically. Take up a hobby, walk the dogs, spend some time with the family, anything to keep you away. I remodeled my entire house with DIY projects because of this. But really, when it comes to drawdowns, as soon as you've had about 4 losses on the bounce, you need to switch from chasing profits to capital preservation. What's the difference? Well, the difference is that while you should still take trades with an intrinsic profit margin of 3 to 5 times risk reward, after 4 losses, if your trade reaches 1R, just take it. Once you've covered the 4 losses, which actually happen in slightly less than 4 trades because of the compounding effect, then you can go back to chasing profits. Another thing you need to do is to limit the number of trades that you do in a day. Drawdown or no drawdown. That's just good trading practices. So one way to approach this risk model is to ensure that your risk reward that you're getting on your home run trades, so your R multiples expectancy, matches the number of trades you will do in a day. So if you're always aiming for 2 to 1 and you have quite a few trades going to 2 to 1, that means 2 trades a day, allowance. In hypothetical conditions, let's say that your first trade reaches target, so you get 2R, you're probably best to leave it alone and just walk away. You've done your job, you've made your money, you're up 2R on the day. You're done. But even if you then still decide to do another trade that day, even if you lose one, you're still up 1R on the day. See how that works? So whatever your R multiples are doing with your home run trades, that should be the basis of the risk model for how many trades a day you should be doing. Now, this approach will ensure that you have the possibility of being up on the day nearly every day, purely from a statistical point of view. One final point is to ensure that your trades do have a statistical chance of reaching more than 1-to-1 risk reward. So don't take trades that have congestion areas on the way to a target. Whatever method you're using, whatever zone you might be looking at, you need to have a clear space between your entry and your target, using the time frame as a reference where you found your setup. There are a few other statistical things to keep in mind. For example, to ensure that your stop loss is appropriate for the daily range of the product you're trading. Because using a 15 tick stop on Aussie dollar is not the same as using a 15 tick stop on crude oil. Why? Because crude oil is slippery. It has a massive range for most of the year, much bigger range than Aussie dollar. But either way, the process for any drawdown or any progress in general is to tweak, adjust, improve, tighten, keep going. If you're not prepared to do this, to constantly monitor yourself and your trading business for expenses, budgets, and profits, then you may have to consider that trading is not for you. Certainly not day trading. And there is nothing shameful in realizing day trading is hard. It is not for everyone. It is the toughest thing you will do in your life. The revelations that trading brings in the form of self-discovery, they're quite often very unpleasant and downright brutal and violent for most. But at least you will emerge out of the whole experience a better person with a much better understanding of your own mindset and which areas need work. So not only in trading, but in life in general. Not everyone will become a consistently profitable trader. Just like not everyone will become a professional football player or an Olympic athlete. Most people actually prefer the security of a 9-to-5 job, and there's nothing wrong with that. If you're still interested in staying in the industry and making this work for you, perhaps you should focus not on day trading, but on a much easier version, which is medium-term stocks investing. If that's the case, stocks investing, holding positions anywhere from 3 months up to about a couple of years, it needs a very different approach. It starts with sector research, but it also takes a lot less skill. Razor-sharp timings on entries, not that important. So you might actually be better off trading medium-term investment. I've known quite a few people who eventually decided day trading is not their thing. Generally through my silver and gold programs, I do have a pretty high rate of people getting funded and going to work for prop trading companies, either mine or somebody else's. But there are about 20% of people who do decide that day trading is not for them in the long run. However, a lot of them went on to become very decent investors because of the day trading experience they went through. You will be very surprised to see how differently you can see a stock chart after you tried to become a day trader. So check out the link below for my stock trading Udemy course that explains the exact steps to start value investing the right way. So that's it for this week's video. Comment down below if you've had day trading losses, how did you deal with it? Until next week, click here for more trader issues and click here for the weekly strategy videos.